Appreciate everybody joining today. We've got some really awesome content prepared that I'm excited to walk through with Ryan. I do need to get a couple of household items out of the way first. Please keep in mind that the content of this webinar is meant for educational purposes only. It is certainly not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Just a couple other items here. Do want to point out that we'll leave some time for a Q&A session with Ryan at the end of today's webinar. There is a Q&A feature down at the bottom of Zoom, which you can use to submit your questions throughout the session. And last but not least, we're recording the webinar and we'll send out a recording via email to everyone that registered tomorrow. And it will also be available as a replay on our YouTube channel. Please remember to like and subscribe on that YouTube channel so that you don't miss any of our future content or recently released videos. I am very excited to be joined by Mr. Ryan Detrick today. Ryan is the Chief Market Strategist at Carson Group. Ryan, thank you for taking the time.
I'm honored to be here. You guys invited me a while back, so this will be fun. Get to do this. And I did bring. I'm not going to wear it because I don't want to mess my hair up. But there's my hat. There it is. I've got some YCharts gear. Of course, I got the Carson thing here. Got to promote. But nonetheless, I wear that hat a lot. If you ever see me on social media on the weekends and places, I sport my YChart stuff. So yeah. So thank you, great partners, and I'm just honored to be here. And you know, the whole theme of this was sell and may go away. Maybe it's not going to happen this year. Here we are. We'll get into it, but my, oh my, that hasn't happened this year, but we still see some positive things. So it's going to be a fun discussion, and it doesn't hurt. I always say I don't. So I'm on TV in a little bit. People just joined the CNBC, and I always like going on when markets are green. And last I checked, we had some more green out there. So that makes it a little easier. Yeah.
Makes it a lot easier. I've got a hat behind me too. Maybe the next time we do this, we can do the baseball hats.
I don't want to mess my hair. I did just get a haircut. Honestly, I got a haircut like an hour ago. I don't know if you can tell if it looks good, but you know, $40 haircut. Hopefully it looks good. Oh, my hair looks better there actually, though. I don't know.
There you go, and a beautiful jacket on as well.
Yes.
So as people are watching the webinar today, we're going to have a lot of charts in the background. A lot of these charts can be built in YCharts. Just keep in mind, there's a QR code that you'll find on a lot of these. You can use that to register for a free trial. You can also just head over to YCharts.com, find it that way. And remember, as you have questions, we're walking through some concepts here. Ryan's going to be telling us a lot about what's been going on and what might be going on in the future. Please drop those comments down in the Q&A section, and we'll make sure we hit them at the end. So without further ado, let me walk us through the agenda here, Ryan, and then we can get into some of the fun stuff. So we're going to start off going over some market overview charts. Then we're going to turn it over to Ryan. He's going to talk us through a blog post he put out at the end of April, kind of debunking the whole sell in May theory, or talking through some historical trends there, which are pretty interesting, and looking at some alternatives to that theory. We'll then look at some really interesting data on how to capitalize on 2023's unexpected gains, and then we'll jump into that Q&A section. So without further ado, Ryan, let's get into the core content here.
Yeah.
So our first chart, a lot of big indices on here, a lot of green, which is nice. Huge outperformance from the NASDAQ year to date, pretty unbelievable. What do you see? What do you make of the performance year to date in some of these indices?
Yeah, I mean, boy, I knew the NASDAQ was up a lot. And then you look at a chart like that and it tells a good story, right? A lot of ways to go with this. I mean, the truth is, by the way, everyone, 8 months ago, like yesterday, okay, that was 8 months since the bear market low, right? The October lows, October 12th, I guess. And when you look at that, you know, we've come a long way. And there's lots of ways to look at things here, but you know, midterm years historically aren't that good for stocks. You tend to see bear markets in midterm years. We had a 25% bear market last year on the S&P, more on the NASDAQ, more in small caps. And obviously now we've had this snapback rally. You know, we've been more neutral, technology in general. One of our base cases, we think yields are going to stay a little high. We think the Fed is done, but we think yields will stay a little bit higher. That might be a slight impact to technology, but we're more neutral. But so this strength has surprised us a little bit, I guess you could say. But it's nice because you think about last year. So what do? Right? I'm a chief market strategist at the Carson Group. What are they? They're one of the largest RIAs in the country. We've got over $22 billion based in Omaha. I'm not in Omaha. I'm sitting in Cincinnati right now. But, you know, I get to work with over 350 advisors every single day talking about these things. And you think about it, everyone, last year, I know we remember it, but let's just hit rewind for a second. Last year was one of the worst years ever, right? S&P down 20%, but long-term bonds were down almost that much. And bonds in general, the Barclays Ag, I believe, was down 11 or 12%, close enough for government work, like the worst year ever. So it was one of the worst years for investments ever. Sure, if you stuck in energy, you did okay last year. That's about the only place to hide out, maybe the dollar, I guess. Other than that, but now one of the key concepts, the idea that, stocks rarely are down 2 years in a row. It can happen. Great Depression, tech bubble for 3 years, 73, 74. We upgraded our view on equities in late December last year when everyone was literally lowering their targets at 25 strategist, Bloomberg survey. The median said negative returns this year. Everybody's talking about this recession that we're going to see. We can get into the economy and things like that, but we didn't see a recession. We saw a bounce, not even a bounce. We saw pretty good moves. And in our outlook, we actually said we maybe could see new highs this year, which sounded crazy if good things happen. Unfortunately, good things are happening. Last comment on this, I can just probably talk all day. We do think one of the key concepts of the second half of this year will be broadening out. Yes, the big five, the big seven, what magnificent seven, I guess what we call those big seven tech names, communication names. That jobs number we had a couple of Fridays ago, we think was a game changer. Since then, what's happened? People are realizing we're not in a recession. Look at today's retail sales numbers, better than expected. Consumers still strong. Lots of different things. The economy's not perfect, but manufacturing was in a recession last year. So was housing. Both of those things look like they bottomed. They're starting to go higher. They could be tailwinds to the economic growth the second half of this year. What does that mean to someone listening? If you're not going to have a recession, we think second half of this year, some of I don't think the NASDAQ necessarily has to come down, but maybe those other things catch up to it, right? We really like small caps. We like cyclical value. Some of those areas could do really well as the realization that there's no recession coming. They talk about it on TV every day, it feels like. We hear about M2 collapsing. We hear about the yield curve inverted. There's a lot of other factors, though, that go into it, specifically the consumer, who makes up 2/3 of the economy, growing 5 million jobs last year, another couple million jobs this year. Things are still strong. So overall, it's an impressive year. It's just a big bounce back from where we are. The S&P still, I think 9% from an all-time high. So it's not like we're at an all-time high. We're getting closer, obviously. But I think, the key concept that the rest of this year, that those others could catch up to the NASDAQ, and that adds that breadth, right? Only a couple stocks going up. There could be a lot more market breadth, and we've started to see that a lot since a couple Fridays ago with that big jobs number. So that's my opening comments. I just talk a lot.
No, this is all about the market overview, right? So it's perfect. I think the big picture is what we're interested in here. Yep. And maybe going into this next chart, drilling a little bit deeper on equities, right? And thinking about sectors. I mean, you see tech, communication services just roaring this year, and energy, the laggard, big reversal from last year. Do you expect that broadening you talked about to occur here as well?
Yeah, I guess I kind of gave a cheat to what I might talk about on this one. You think about energy specifically, 2 years in a row, energy stocks gained at least 50% or more, right? The last 2 years. Last year they were big, but even the year before. And the key, we are currently right now on the models that we run for our advisors, we're overweight energy, overweight small caps, overweight industrials. Those are the areas that we like here. So we do think, yes, energy's had a rough start to the year. I know every time I look, crude's flirting with 70 or so. We think crude will find a bottom there, and potentially energy could do well catching up. The consumer discretionary is interesting. I just talked to someone about it this morning. 25% is Amazon. I think it's 18% or so is Tesla. So you're talking like 40% of it is two stocks. Yes, Tesla had that great run up like 13 days in a row. Amazon's been fairly strong lately also. That's a big part of why consumer discretionary is strong. But you peel back the onion, as I like to say, cruise ships are doing really well. Chipotle, McDonald's, restaurants. I mean, it's hard for me to think there's this big world-ending recession coming like we keep hearing about when consumer discretionary is strong. And what's that telling us? We think it's as simple as the stock market is sniffing out better times from the economy the second half of this year. What have we seen throughout history? Stocks lead the economy. I mean, we see that time and time again where stocks get weak, economy strong, but it was sensing some weakness. We probably saw that last year with the stock market, the way it acted ended last year, early this year with some economic weakness, vice versa. May of 2020 is one I always remember. Stocks up a huge, I think they had like a 9%, 10% gain just in May of 2020. Yet the worst headlines, you could argue, in our country's history, or some of the worst headlines, I should say. So it's a leading indicator. We think the strength from discretionary specifically is saying again that the economy could be on better footing. But the cyclical value is who we like. And you think about it, like let's say utilities, staples, some parts of healthcare, those are the more defensive areas, right? Low beta areas. And I don't have the chart, I'm aware, but I did share it on Twitter last night. You look at high beta versus low beta, high beta versus low beta. High beta just broke out again. We want to see that. We want to see the utilities and staples and parts of healthcare that are weak. Real estate, maybe you can lump in there too. And that's fine. It doesn't mean they have to go down. Maybe they just don't go up as much as the rest of the market. That's kind of what we're seeing here if you look there. So that weakness, if you will, a relative weakness from those areas is what we want. And we've been seeing that. And those are some positive signs, I think, for sure. But, again, tech and communications, maybe those go a little sideways, catch your breath. We do think the opportunity is some broadening out of overall for investors. One final comment, working with advisors like I have for 8 years and their clients, one thing I've seen time and time again, think about what's a mistake somebody makes. It's a shiny object. Like right now, people want to buy some tech stocks. Well, they've had a great run, right? I mean, they didn't want to buy them 8 months ago, right? And again, we've seen this throughout history where, that's doing well. Maybe someone on this call, you called your advisor and get me out. I want to buy some Bitcoin. You want to do that at 60,000. And again, not a recommendation of Bitcoin at all. Just making the story here that, chasing returns and chasing the shiny object is not really the way to continue to grow your portfolio in a safe and in just a safe manner. One final thing, the quote, I hope I don't butcher it. Eisenhower said, plans are useless, but planning is everything, right? What have we seen throughout history? I mean, yes, there's bear markets. Yes, there's recessions, but stocks tend to come up. I am a market strategist. I have usually the world is going to keep going and the sun's going to come up tomorrow type of mentality. And when you have these pullbacks and these scary things, have that plan in place ahead of time. Don't say, you know what? I want to buy whatever stock you're thinking of if it's down 15%. And then it's down 15%. And you know what? You turn on CNBC and you hear some guy in there talking about the Hindenburg moment, and everyone's talking about all this crazy stuff, and it scares you. And that's the way our brains are worked. That's the way psychology works. But have these plans in place ahead of time are so important because, again, every year on average, no such thing as average. I'm fully aware when it comes to the stock market, but on average, you see a 10% correction a year, 3-5% corrections. I mean, these things happen. They're going to happen again. Bear market every 3 or 4 years, give or take. The final thing, the other thing that's happened though, since 1896, May 26th, 1896, the Dow started trading. Recessions, depressions, wars, 2 100-year pandemics, deflation, inflation, all this terrible stuff. The other thing that's happened, stocks have come back to new all-time highs every time. Believe me, sometimes it takes longer than others, right? That can happen. But again, we don't think this time's going to be too much different. So for investors here, these are things to remember that time is on your side. And a lot of times you pick good companies. Don't always chase shiny object. That's going to help you reach your long-term investment goals.
Ryan, you just made our CEO, Sean Brown's day. That's his favorite quote, that Eisenhower quote. So
really?
Nice job there. Maybe he planted that on you beforehand.
Okay.
You also had a great segue here because if we jump into the next slide, wow, look at these names. Some unbelievable market caps. Hard to even wrap your head around some of these. And obviously the news lately has been NVIDIA kind of crossing that $1 trillion threshold. The thing that stood out to me looking at this is just the volatility in these names over the last 5 years. What do you think of these names? I mean, they make up such a big part of the market at this point.
Yeah, I guess they're the tremendous seven, right? I guess if you look at those, it's it is fascinating. Just the growth that we've seen, and I don't think it's bad. I mean, people talk about, only these 7 stocks are going up. I've been saying that's not true for quite a while. Other stocks are going up, maybe not going up as much as these. And we've seen the scary charts that the top 2 stocks are, I don't know what it is, 14% of the S&P 500. Don't quote me there, but whatever it is, like historically large positions, and there's some potential worry there. And I've heard a lot also about AI, right? So this is kind of in the world of AI. We got the $1 trillion club. AI has created so much excitement. A year ago, think about where we were, right? What was happening? I mean, 40-year highs in inflation, the terrible war that was happening, China lockdown, shut down. They couldn't make their mind up. They hurt all these chips because they're on lockdowns. All these supply chain issues were taking place. Now this year, those things are like almost alleviated. I mean, there's no supply chain issues anymore, right? You ship something from Shanghai to New York, it's down like 88%. Those shipping rates are down. So things have really come back. But the other thing about, are we in a bubble? Are we in an AI tech bubble? I don't think we are. One of the big differences between these names on this screen and what we saw in late 90s, for those of us who remember those times, these companies are what? They're making money. Now, that doesn't mean they can't be overvalued, but they are making money. And to say that, Amazon's a tech company, I don't know. They're everything. I mean, you can get anything from Amazon, right? I mean, they literally send you medicine now, all these different things that Amazon can do. But anyway, so you think about it, we don't think it is. And maybe it's like, a 95, 96 period. Yes, that was the late 90s. Well, what happened? S&P gained a couple 100%, literally like the last 15 months of the NASDAQ before the March 2020 or March 2000 peak, well over 100% rally. Now that was bubblicious. Absolutely. But again, from an investments point of view, we think think it still makes sense to have exposure to these. Like I said, we're more even weight these groups here, or these names on the screen probably here. They have had incredible runs. We think they come back a little bit in some other areas, take the baton. The lifeblood of a bull market is what? Ralph Ekampora talked about this many years ago, probably before a lot of us were born. The lifeblood of a bull market is rotation. Different groups taking that baton. Clearly, these names, Tech Communications, have had the baton, for a while now, 6-7 months, give or take. And you see what's happening now. That baton might get passed around. That's not bearish overall for these names. Maybe this time they take a well-deserved break. But again, different groups can do well, and it's unique. And at the same time, it's the innovation, right? And just the truth with America and how we continue to just the resolve, I guess, what I want to say with our country. I remember not too long ago being at conferences, 2015, probably, if I look at that. Yeah, 2015. Think about who's the first $1 trillion company. Who's the first $1 trillion company? Now, Apple's what, $3 trillion company. So it's amazing, and having some exposure to these names makes sense. But we just think maybe it is a time for a tad of a break here. And some other areas participate on the upside a little bit more.
Yeah, and another good segue, because we're going to dive into some of the top performers in May, and there's some similar trends here, right?
Yeah.
A lot of semis on here, a lot of travel and entertainment. What do you make of some of the sectors that are outperforming, I guess, and the companies in those sectors that are doing so well over the past month?
Yeah, I mean, semis, why are they up, right? Well, AI. I mean, we know that, right? The explosion and the excitement over AI, where it could go, where it could take us. The inner contrarian in me, though, I traded options for 11 years, so I tend to look at the world. If everybody's thinking alike, somebody isn't thinking, said General Patton. I use that a lot, much like, literally in late December, when we upgraded our view on equities from neutral to overweight, added equity exposure in a lot of the models we ran for our advisors and our partners. They looked at us like we were crazy. Outwardly, internally, people thought we were crazy, but everyone was saying the same thing. So much stuff was priced in, so much bad stuff was priced in. You get any good news at all with the fact that we thought we could avoid a recession, which sounded crazy 8 months ago. Now it's looking, even the Fed kind of hinted at that yesterday, if you look between the tea leaves with what they said. But again, what are we seeing now? AI is great. And you got semiconductors doing amazing, 3 top performers. And you look at the cover of Barron's this week. I'm a big fan of Barron's. I read it every weekend. They got a bull on there talking about the bull market, right? They weren't saying that back in January. So the contrarian in me thinks, okay, not saying it's too crazy here. NVIDIA up 36% is like doubled for the year, I think, something like that. I mean, it's up a lot, right? So maybe it's a little time for a break. But what gets me is more the travel names, entertainment names. The idea that Live Nation, right? I mean, that could be the Taylor Swift the Taylor Swift phenomenon,
right, yeah.
But it is what it is. I mean, the market is sensing things. The market is sniffing things out. So many people, and I know this because when I do a tweet that's been bullish, and that's most of my tweets have been bullish for quite a while now, just the pounding that I've taken, and people just say, you're wrong, this. I don't argue with the market, right? I mean, we've been seeing signals repeatedly since the start of this year. Just the fact that, the five first days were higher, the Santa Claus rally period, stocks were up, and then stocks were up in January. The next 11 months are higher like 90% of the time, up significantly. I don't remember the exact number. That's just one stat. I get it. When you have a down year like we did last year when last I checked, then you're up 5% in January like the S&P was. I call that a slingshot effect. It's only happened 5 times. The full year's up close to 30%. I mean, I was talking about that late January, early February. I didn't say this year gained 30%, but I was saying something's happening here. You can argue with the fundamentals. You can argue with the Fed. You can argue with your stocks. You can argue all you want. Something was happening earlier this year that a lot of people were ignoring because they were looking at the yield curve inverted. And I'm not ignoring the yield curve inversion. I'm just saying there's some other things that to us matter a lot more. Specifically, how's manufacturing doing? How's housing doing? How's the consumer doing? Yes, the inverted yield curve was a fun. Middle of March, what happened, right? We all know the banking crisis. Well, stocks gained almost 4% in March, right? And it was scary in the middle there, but then it was pretty clear. This is just a couple companies made some very, very poor decisions. Yes, bonds got hit harder than like any time since George Washington was president, according to some of the data that I've seen. So they made some poor decisions, but the bottom line, again, it was just company specific. And you look under the surface, we didn't see credit spreads widening. We didn't see major worrisome signs middle of March. We actually added some equity risk to financials in the middle of March. And when I tell you, people thought we were crazy when we did that, but we saw some positives there. So anyway, I'm going on a rant, but I think the idea that Carnival, Royal Caribbean there, the Live Nation is leading is positive things that the economy's not in recession. Final comment on this. I did buy, I'm going to get personal for a second. I bought 6 tickets for Taylor Swift in Cincinnati on July 1st. My daughter wanted 2. I was in line forever. I was in one of those people that, watched the little thing move and then it would crash. It was as stressful a thing as I've ever had. She's at high school calling me, texting me all day. You get the tickets yet? Get the tickets yet? I'm like, no, I don't have the tickets yet. I spent all day. I was very unproductive at work that day. Sorry, don't
Dad of the year.
Yeah, I got the tickets. So what I'm getting at though. So then I get there and I could buy the tickets. So I bought 6 of them because I'm like, I'm going to buy 6 of them for $4,200. So that's a ton of money. Don't get me wrong. Absolutely crazy amount of money. I sold the other 4 last week for 10 grand. So you can't tell me we're in a recession when people are paying these crazy numbers for just this Taylor Swift stuff. I mean, the Taylor Swift phenomenon, we've joked internally. I've got a podcast called Facts versus Feelings. We've been joking for months. It's the Taylor Swift effect. There's no recession coming. So it's half playful here, but at the same time, it just doesn't feel, I remember the last couple of recessions, right? I mean, lockdown, obviously that recession COVID was very scary. And then financial crisis. I mean, we're all worried about we're gonna have a job every Friday, people getting laid off. This never quite felt like that. Yes, if you were in housing, if you were in mortgages, I mean, believe me, the past year hasn't been fun. Manufacturing, obviously, but other parts have continued to move higher. At the start of the year, and I swear this will be the last thing I say, I can go all day. Well, we saw all these headlines about these big financial, maybe none of these quite on there, but the big layoffs from Meta and Amazon and Apple. And yes, that got the headlines in, we'll call it January, February. They were laying off 20,000 people here, 12,000 people there, not minimizing it if they were in there. But what they don't quite tell you was those companies added like 500,000 jobs the previous 3 years. So it's real, just kind of trimming the fat, if you will. And a lot of these names on here, specifically those travel names, were actually adding a good amount of employees because they were getting back and hiring. And again, that's with the media. I do a lot with the media. I love the media. It's helped my career, but don't always kind of believe what they're telling you. Their job is to get your eyeballs to watch what they're doing. I do the same thing in blogs. Hey, is a bear market coming? Question mark. No, it's not. But sometimes you just need to get that attention grabber, and the media does that. So it's just important to know, I think, kind of, what their game is and what our game is. Our end game is to find the best research we can, best data we can, make the best decisions we can, sometimes ignoring those scary headlines, because a lot of times those scary headlines are just there for a reason to get you to click on them. So I went all over the place on that slide, but hopefully something works for you.
A ton of great stuff in there. And one of the things that I took out of this next chart is there's some breadth here. But what surprised me was all the consumer tie-ins, though. It does feel like everything's pretty healthy right now. What do you make of some of the names on here and their tie into the consumer? You take anything out of that?
Yeah, I mean, the short answer is no. I know Advanced Auto Parts specifically, they've had some companies, again, please understand, none of this is recommendations if I talk about individual equity, but they had some specific problems to their company, Newell Brands. I mean, some of these, they didn't manage supply chains correctly, or they were caught in that, or they didn't manage, prices. There are things, there's always winners and losers. I mean, we know that. And again, maybe some of these that were down, I mean, I don't know exactly what's AutoZone look like. What's some of these other ones, taken from one, given to the other, or vice versa. I think in general, auto parts maybe struggled a tad because of some of the higher prices and supply chains, but still over the top, not overly concerned on some of those. Again, I think a lot of it is company specific. I was a big macro thinker. I don't get too in the weeds on individual equities unless it's the real big one. So I'm by no means an expert on any of these names. I do know Advanced Auto, which is down more than anybody. I mean, it was down like 70 or 80% coming into this year. Right now it's down another 50. I mean, it's struggled for a while. I'm willing to take a guess. Probably a few of those other names on this list were somewhat similar.
So I think that brings us into recapping your recent blog, Ryan, which was basically breaking apart the whole sell in May concept, right? So I'll turn the floor over to you here. I'll keep controlling the slide deck. You just tell me when you want to jump forward, but I'm excited to walk through some of these because you pulled apart some really interesting stuff in here. So I'll jump into this first slide and turn it over to you.
Well, thank you. Yeah. So Carson, carsongroup.com, we've got a blog on there, and that's, you guys saw that I shared it. Say, hey, come on and we'll do a little webinar and talk about some of this stuff. So I laid out I've kind of already given our views on the world. We came into sell in May, go away. What is sell in May, go away? Well, it's the worst 6 months of the year historically, which you can see there is May through October. It is what it is. It's factual, right? It's not up very much of the time, or 64% of the time, and up less than 2% on average. And the media is all over it. I'm all over it. I talk about it because I know it'll be popular. Certain things like the Super Bowl indicator, sell in May, go away. Certain things that happen every single year that get a lot of pub in the media and people talk about it. And I love to do that, but also like to kind of poke holes in things, right? And that's kind of where we did with this year, talking about the idea that there could be a surprise summer rally, and maybe there isn't a sell in May, go away. And with all you saw was just this, you'd say, well, there has to be, right? But there's so many other factors. And I am a macro thinker. I mean, I use the F word both ways, Fibonacci and fundamentals. It's a joke I use either way. I mean, I like to look at technicals. I do have a CMT. I'm a chartered market technician. I am not a CFA. I hated accounting. I love the idea of supply and demand, looking at history, telling stories as a market strategist like I am. I think a lot of my job is to tell stories. And what I found people really liked was telling stories of history, where we've been. Nobody knows where we're going, but to show, we've been here before. We've seen something like this, and here's what happened next. And 9 times out of 10, what tends to happen next is we did okay. We got through it, right? Stocks did come back. So maybe you have a well-deserved summer break some of these years. Last year was terrible. One stat, I don't have it in here, but it's good time. So again, the eight months since the low, right? It was 8 months ago was the low. And you look at history after you go 8 months without a 52-week low in the S&P 500, very rarely do you go back to new lows. It's only happened like maybe once or twice. It's extremely rare. But a year later, you're up like 15% on average after 8 months without a new low. The S&P 500 just this week made a new 52-week high. All right, you look at something like that a year later, when the S&P goes, this is wild. When the S&P goes a year without a 52-week high, like we just did, and we just made one earlier this week, 1 year later, S&P's higher 15 out of 15 times. I don't make it up. I just report it. So I shared a lot of stats like that leading into sell in May, go away. And that's why we kind of said, there might be the opportunity for, a good bounce in this sell in May, go away. And that's clearly what's happened. Now let's go to the next slide and see what else we've got here as we dive in. So yeah, this is just one of those factual things. This is the sell in May, go away return. So again, those 6 months. Historically, the last 10 years, you guys tell me, not too bad. And last year obviously was weak. A lot of factors happened last year. You think about last year, though. I mean, so you get some pretty good returns. But I remember those times, right? 2020. Sell May, go away. Well, we had the big March lows, April, May bounce, and a really good continued bounce off the COVID lows as the stock market rallied 120% off those lows. 2021 was strong, but really some strong returns. So just knowing, if all you heard was sell May, go away, and I showed you that first chart, you'd say, oh my goodness, let's get out of everything here. Or not get out of it, but at least go to cash, or maybe go to some Sam Stovall, big fan of Sam. For a lot of people, if you follow me, Sam looks at the world like I do, or maybe actually I look at the world like Sam does. He's done a lot longer than I have. Talks about getting some of those defensive things maybe during the sell May, go away is where you should go. That wasn't what we were saying, though. I mean, we were saying stay aggressive, stay with small cap cyclicals, like I said, that are starting to do better. But you think about last year again, all those things I talked about already, but I think it's so important to point out, they call it a black swan for a reason, right? I mean, 40-year highs in inflation, the Fed doing what it did, the lockdowns, the shutdowns, all those things took place all around the same time, right? First, second quarter of last year. And it impacted things significantly. What made last year so hard for investors in general is usually when stocks zig, bonds zag, and vice versa. We didn't get that last year at all, right? It was the worst year for a 60-40 portfolio like ever, all right, with bonds down 11%, S&P down 20%. Different sectors might have done better or worse, but overall, it wasn't good. I mean, if you're from that point of view. But again, when you think about it, if we get a little more back to normal, right, our outlook, which we released 6 months ago or 5 months ago, started writing it 6 months ago, we called it the edge of normal. And the big theme that we've had this year, and we're going to write about it next month when we release our mid-year outlook, we're getting closer to normal, right? And again, in a normal world, recently, sell in May, go away wasn't all so bad, And again, even if maybe go back to the one before, if you could, just for a second.
Yeah.
What was that? I mean, so that's still 1.7% over 6 months. I mean, that's an average, yes. It looks red the way I created the chart, or you guys helped me create the chart, but still, it's still a positive return. I mean, so that's not too bad overall, especially when you consider those best 6 months historically are when things do well. But again, let's just have that in context. Now let's go forward again, back to the other one where we just were. Yeah. So anyway, so last year, all these headwinds, and now you've got some tailwinds, and it's just the idea and just the overall negativity. I mean, I love to look at, sentiment flows and put to call ratios, and coming into this sell in May, go away period. What were we dealing with, right? In May, what do we hear about all the time? The debt ceiling. I mean, the media made it sound like this was just going to be this horrific situation. We're going to get a debt downgrade, massive spikes in interest rates, going to fall into a recession. We were saying the whole time, no, this is just like made up Washington stuff. It's going to get done. 89 times since 1959, the debt ceiling was increased. Every single president since Eisenhower's increased the debt ceiling at least 3 times. And President Biden did it once. We said, it made sense. He's probably going to do it again. So you can call it kick the can. You can not like the fact our country has so much debt. I'm not getting into any of that. I'm just saying the overall sentiment backdrop heading into sell and make away with all the trouble that we were supposed to have with the banking crisis that we heard about that really hasn't happened. And then the sell in May, those kind of had that, had things ready to spring higher once those potentially were out of the way. And again, that's kind of some reasons we weren't so sure about sell and may go away. Let's see what we have next. Will be a surprise to me too. What do we have?
Yeah.
Here we go. All right. This is just plain and simple. And one of those, again, it is what it is. Going into sell and may go away, we said, well, look at recent May returns. You guys see it there. I mean, those are some fascinating returns. And I was shocked. I double checked it because I didn't even remember 2019. 2019 was a great year for stocks. I mean, it's really economy doing well. Good year for stocks. Overall, things are going pretty well. And then I looked down 6% and sell and may go away. The only time the last decade stocks were down in May. So that surprised me a little bit. It's true, actually. It happened. But again, you barely had returns. You had a 1% or 1 basis point gain in 2022, 25 basis points in May. I mean, it was a late comeback. I think the last couple days in May, we had a really strong rally to finish positive. But again, just looking at recent history, I joke, maybe we should call it sell in June, because historically June doesn't do all that well, although this one sure is this one's sure pretty good. But again, just being aware that sometimes these cycles, and believe me, you wouldn't blindly invest in just this. I mean, I like to look at the fundamentals, the earnings, momentum, relative strength. I talked about market sentiment. The Fed, again, the Fed was a major headwind last year. It is what it is, right? All that hiking they were doing, and you see like Gunlock yesterday, and I don't totally disagree with this, saying the Fed should have been hiking interest rates way before they started. Then they just did a whole bunch of hikes, and now where are they? Now they're talking about maybe even hiking again. Maybe 6 weeks. We don't see that at all with inflation coming back. PPI has just totally come back. We don't think there's any need for a hike. The Fed's talking the game. Market didn't believe them. Yesterday specifically, and today, the follow through. I mean, the Fed dot plots yesterday, everybody, what did it say? 2 more hikes coming this year. I think 12 out of 18 of the Fed members said at least 2 hikes and still this year. It's the Ron Burgundy quote. I don't believe you. I think it's how it goes. Anyway, Ron Burgundy. It's not, the market didn't buy it. Market didn't believe what the Fed was selling yesterday. And now we're getting some follow through today, which is nice. Because let's not forget when Jerome Powell took over and everything was getting going there when they started hiking rates. Powell would talk. Maybe you'd have a bounce that day, but the next day would just be a bloodbath. This time last year, and we had some bloodbaths, the day after. People go home and think about, what the Fed just say? Oh, you know what? They said this. And then massive selling days after Fed hikes over the past 10 months or so. Tell me about today. We're not getting that. So again, that's a positive, I think, a much different story, if you will, than what we were seeing before. But anyway, May historically can be strong, and we barely cracked positive the last 2, but hey, they were positive. Let's go ahead to the next slide.
Green is green, right?
That's right. Yes.
All right. So how about some alternatives for this sell in May concept?
Yeah. So here I broke it down a lot of different ways. This is per month. What is interesting to me is June doesn't do all too poorly in a pre-election year. We are in a pre-election year. I've shared these charts. You've probably seen them. Your average pre-election year tends to gain about 17% average. A lot of the time stocks are higher. Midterm years, like we talked about a few minutes ago, historically are some of the worst years for stocks. And you think about that first year of a new president, things are going good. Maybe by that second year, you hit some bumps in the road. And then by the third year, you tend to get, and it is what it is. It's not about red or blue. It's about getting the economy going, getting people feeling good. The government can push certain levers. I mean, that's why we didn't think there was any way they were going to let, the default happen and all the different spirals of debt that were going to come from potentially a debt ceiling issue. Because again, it's elections right around the corner. It's not that far away. So you think about it though, you look at this and then you're in July. And I wrote some things 2 weeks ago on our blog talking about June and why the likelihood of a continuation. Believe me, I didn't think we'd be up 5 or 6% in June on the S&P right now. We're looking at one of the best Junes ever. Now I know there's still a good amount of time left. I haven't had Father's Day yet, but nonetheless, this June rally has been really impressive. And then July also strong. And one thing that I shared before it on the chart, but I'll explain it. When you look at years that gain at least 5% in January, like we did this year, March, April, May tend to be a little sideways. This is your average year that gains 5%. So they catch its breath. In essence, the market catches its breath. And we saw some of that in May. We just showed up 25 basis points down a lot of May. I mean, the market kind of caught its breath in May and has obviously exploded to the upside once we had that better jobs number and realization there's no recession coming anytime soon. But when you look at a year that's up 5% in January, you see a rally in June, July, into early August. And that's something we've been talking about a lot, that the potential for this summertime rally that nobody was expecting. Just 3 weeks ago, I was on CNBC with Scott Wapner, and he's like, "You really think there's gonna be a rally this June?" I said, "Yes." And he gave me this look like you're crazy, because every guest he's got is talking about the end of the world's on the way. So I get to talk to him here in about an hour or so. So we'll remind him of that. But nonetheless, when you look at that, the summer rally tends to happen when you have a 5% bounce in January. It's just one data point, one statistic. There's lots of factors to look. When you start stacking these on top of each other, I think it makes sense. And honestly, hey, maybe we're due for a little bit of a break. I mean, wouldn't it be something? We're flirting. Well, I guess we broke above 4,300. 4,300 is on the S&P, where we peaked last August, right? We had that 18% bounce, give or take, last August, and then rolled right back down into the October lows, the end of the bull market, so to speak. Although most stocks hit a 52-week low in January. We call it a bang and a whimper. Or not January, June, sorry. So the market went down in June, then rallied and came back and broke those lows in October. But less stocks made new lows. Small caps did not break new lows. Mid caps did not break to new lows. A lot of sectors did not break to new lows. You know who did? Technology, communications. Those were the groups that did. This stuff we were talking about literally then in the middle of October, that, hey, pretty scary what's happening. But the idea that we just had a 25% bear market, non-recessionary, your average non-recessionary bear market pulls back how much? 38.4%. Pretty close to where we were. So we were kind of right in that line. 6 of the last 17 bear markets ended in October. We think we just had another one. In fact, I think we just did, right? Officially now, end in October. These are some of the things we were laying out back then for the idea. And, oh, by the way, it's the best 6 months of the year. I mean, I showed the chart originally. It's kind of where this whole conversation's going. Then you had that rally. So again, the likelihood that we can rally a little more this summer, and then you get to some of those other months that aren't all that great, August, September, and really the first part of October, I wouldn't be shocked at all. You got bulls on covers of barons. I got longtime bears that have been all over the place, all of a sudden kind of capitulating. Some of these guys that had these certain targets, now they're upping them. The market, it has a funny way of not always rewarding everybody. And now that people are getting a little more optimistic, seeing some of the positive things we've been talking about for a while, the contrarian in me thinks maybe we could be due for a well-deserved break here, especially around the 4,300 area where we peaked last summer. But at the same time, that's okay. I mean, we've had a heck of a run, obviously, to start this year. I mean, I don't know where we're up 13% or so on the year, 14% on the S&P as we speak. I haven't looked officially, but total return basis, you're talking almost 15% gain already, right? With NASDAQ up double that, NASDAQ 100 up approximately double that. So again, maybe a little break would be normal later this summer. But what would we do? We're still overweight equities. We're still going to sit there, and we'd likely use that as a potential opportunity to add again to those cyclical value names that we think will make a lot of sense as the economy surprises to the upside.
Yeah, great stuff. I think we've got one or two more in here on the alternatives to sell in May concept. So this one's going through the pre-election year data.
Yeah. So I'm looking at the clock. So it's amazing. We've gone 38 minutes already. Time flies when you're having fun. So I want to make sure we're leaving time for Q&A. So I'll make sure I kind of get through these. This is, again, those worst, quote unquote, worst 6 months. Shared this, in late April. What happens during those worst 6 months? Well, you see it there. Midterm year, by far the worst, right? So the fact that we had a very weak worst 6 months shouldn't be an overly big surprise. I mean, yeah, we were weaker than we thought, but when you look at all the bad things that happened last year, it made sense. And you see they're up 1.8%. So not great during a pre-election year, during these worst 6 months, but again, still positive overall. And you think about also one other thing, I don't have the chart, but I've shared it before. If you look at a 4-year presidential cycle and break it down by quarters on the S&P 500, this quarter and the previous two, okay, are the best quarters on average. If you look at all 16 quarters, we're in the sweet spot for returns. S&P gained 7% the fourth quarter last year, gained 7% the first quarter this year. Gee, we might be up 7% for the quarter as we speak right now with the bounce we've had. So the idea that we've had this big bounce when we were supposed to, when history says it tends to happen, tends to bottom in October. Yeah, stock market pulled back more than we thought. We were on record as saying 15, 18% correction sometime last year made sense. We didn't quite think we'd get to a bear market. Believe me, we did. And a lot of parts were worse, but now we've bounced back even more. And in the middle of when you were supposed to, the best 3 quarters are taking place right now. Now they're about to end, so maybe some of these gains, and it fascinates me to think about it in history, not history, just 8 months ago. Just about every strategist is saying the same thing. Stocks will be down this year. The bear market's not over. We're going to make new lows. Oh, and by the way, a recession is right around the corner. And we said outwardly, listen, the best time to be invested is right now until, middle of this year, if you look at a 4-year cycle. And the economy, we didn't see recession. So you lay this out and everyone's on one side of the boat, opportunities on the other. That's exactly what happened there. But anyway, just the fact that we were so weak last year in the shock, and just kind of be aware that that's when some of the worst times to invest in the 6 years, in the worst 6 months of the year, again, in midterm years. And we don't have one of those coming for a couple more years. So that's a good thing.
I think this might be the last one here. So after a bad start to the year, do you end up seeing a worse sell in May period?
Yeah. And I do a lot of these studies, and I'll be honest, some of them are somewhat similar, which is if you're off to a good start or you're in a bullish phase, what tends to happen? Outsized returns, better than average returns. Now, if you're kind of weak, focus on the negative year to date. If you're down year to date heading into sell in May, which we clearly were not this year, these worst 6 months get really bad. When you're up, and I guess it's on the right, the second one, positive year to date, these worst 6 months are up 4.1% on average, higher 3 out of 4 times. That's not too bad, right? Now, we were up actually more than 6% coming into, we had a good start, real good start to this year. You can see that on the right there, 3.6%, again, 3 out of 4, give or take, or I guess 7 out of 10 really, times higher. So these are some things we were talking about, but I think the key concept being, if you're weak heading into these worst 6 months, that's when trouble happens. Hey, what happened last year? We were down we were down a lot coming into these worst 6 months of the year. Sure enough, that spiraled, out of control, if that's the right way to put it. But that's exactly what we saw. So again, we knew coming in, we were pre-election year. We had a lot of negativity. We had a good start to the year. We were above the 200-day. Lots of these all the negativity that could unwind positively. All these things led us to think that, a surprise summer rally could happen. Absolutely, that's happening with these moves we've seen in June. And we do think there's a little bit more juice left, if you will, to potentially this rally, but wouldn't be shocked at all, again, if we had a well-deserved break August, September, October, which is what you tend to see most of these years. But again, when you have a good start to a year, usually that continues. We're up, over 10%, I think, for the year on day 100, and actually up 8%. Sorry, up 8% as of day 100, which happened a couple weeks ago. Take a guess where this is going. The rest of the year is higher most of the time, up over 10% on average. When you are up at least 8% as of day 100, like we were this year as well. So the trend is your friend. A lot of people on this line probably hear that and listen to it. Don't fight the Fed. The trend is your friend. These have been around a long time. The Fed is likely done hiking, right? 8 of the last 10 times when the Fed stopped hiking interest rates, we think they're done. Stocks were higher a year later, 8 out of 10 times. Yes, 2001 was in there. Yes, 81 was in there, or 2081 were in there. Stocks were lower a year after they stopped hiking. What you got to worry about when it comes to the Fed, though, last comment here, is when they start cutting. Once the Fed starts cutting, that's when trouble. We don't see there's really any potential chance of a cut. Even the Fed yesterday with the Fed dot plots, no one's looking for cut anymore. So that's just something to be aware of. Yeah, when they cut, worry, we're not there. All right, there we go.
So some very interesting stuff there. Now, we know the market is where it is, right? We've had a great start to the year. Some of these kind of get into, where do we go from here? What should we be thinking about, kind of the place that we sit in the middle of June here, heading into Father's Day weekend? So chart of the VIX, right? Looking at volatility, consistent downtrend. What does this mean for investors? And do you expect this to continue through the summer?
Yeah, the VIX is one of the more interesting things, because last year, every time it got down around 20, everyone on TV said it's low, it's low, it's low, and the market would get killed. And it'd be true. The VIX would be low, then it'd go high, and historically, a higher VIX tends to mean stocks don't do so well. But what they don't always tell you, and I wrote a blog on this recently, is you can see here, for years, the VIX will trade beneath 20. For years, the VIX can consistently trade above 20. The VIX has averaged 19.7 since 1990. So that's average, all right, about 20, but it rarely hangs out around 20. The concept that we are laying out here Another sign we are leaving that bear market behind, entering a bullish phase that could last potentially years. And I know it sounds weird, but the fact we just had multiple years of a VIX above 20, now we're consistently below. We just cracked 15 on the VIX, not too long, I think last week, give or take. It took almost 3 years for the VIX to go finally beneath 15. So for 3 years, we traded above 15, maybe how I should word that. The only other time in history it went that long was for 5 years after financial crisis. 5 years after financial crisis, in the summer of 2012, the VIX finally cracked 15 for the first time in 5 years. 1 year later, this is a sample size of 1. I get all the statistics. People might be very mad at me for using a sample size of 1, but I think it tells a good story. A year later, after the VIX finally made it beneath 15 back in the summer 2012, stocks gained 18% the next year. The idea that the VIX is low right now, what is low? I don't know. It can consistently trade between 10 and 20 for years. So is that really low? Maybe 10's low. The world we're in right now, maybe 10's a low VIX. I don't know. I'm just saying these cycles last a lot longer than you think. And if someone's arguing with them, that's probably going to hurt your portfolio, because historically a low VIX means what? Less volatility. We know that. What happens when there's less volatility? Look it up. Historically, stocks do a lot better in terms of returns when you have that. Some of the best years ever were the least volatile. 1995, right? 95 stocks did amazing. It over 30%. I had like barely any 1% gains up or down. Check out what happened in 2008. 2008 had some of the most 1% gain days, most 3-4% gain days ever. 2008 stocks lost 34%. So really, you don't want a lot of volatility. Now, believe me, if there's traders, there's different ways to look at this. I am fully aware, but from a top-down macro approach, the way I look at it, looking to help people reach their long-term investment goals with 1 to 5 to 10-year investment horizons, a lower VIX is really what you want, because stocks tend to do a lot better. And it just kind of what history says, and a low VIX could be here for a long time. I think more than most people think.
So why don't we try to get through the next few in the next 4 or 5 minutes, and then we'll leave about 10 minutes for Q&A at the end there. So I'll jump to this next one, which is a ratio chart, ratio of the price of SPY and BND. What do you take out of this chart, Ryan?
Yeah, first off, I was worried. I said, do I have enough charts? Will I have enough to talk about? Little did I know, I don't shut up. So fortunately, I can fill in some time. But keep this real simple. This is stocks relative to bonds, right? It's a relative chart of the SPY versus the Barclays Ag. Just stocks versus bonds. It went sideways there for a while. You could see just broke out, I think just last week or so, to new all-time highs. We've been overweight stocks, underweight bonds since late last year. I've said that a couple times now. Seeing stocks on a relative basis break out relative to bonds is doing nothing. This is just trend. Yes. Relative strength, yes. Other factors, of course. But to see this breaking out does little for us to change our opinion that stocks are the place you want to be over bonds over the intermediate term. And that's what this chart, I think, confirms. Very clearly. Yeah, it's a good one. So this one's a little bit more complex. My takeaway here is, if I wasn't already feeling optimistic about the market, especially based on what you've been saying for the last 45 minutes, I am, after kind of digesting this chart. It's looking at 1, 3, 6, and 12-month returns following a long period of negative year-over-year rolling returns. Yeah. Break this down for us, Ryan, and tell us what we should take out of this. Yeah, so this is on a monthly basis. And it's not a shock, right? It's starting a year ago, give or take. Stocks were down year over year for 12 months in a row. So we got your statement. You probably were down, right? 12, because again, we were in a bear market. We know that. But just as actually a sell it may go away started, we popped above. So you can see that's what I'm sharing there. As of April, there were 12 negative months in a row. And I shared previous times the S&P was down year over year, 12 months in a row. Once it went positive, what did that mean? Because, hey, you're going down. You need to stop going down before you can go up. Okay, that's simple, but sometimes it's not so simple, believe me. But finally, we popped positive year over year this May. Okay. And obviously we're soaring positive year over year now with what's going on this month. But you can see the numbers there a year later. Is that higher every single time? Yeah, it looks like it is. Higher every single time a year later, up, what is that? 15.3% on average. Just another type of layer of things that I talk a lot about on these studies. But again, that's just a final positive note that we're finally positive year over year after a long time without being positive. And history would say, you look at some of those dates, the green ones on the screen, that's when it took place, usually after a long bear market is over, rarely where you're just going to fall over right back to new lows. Anything can happen, but this is just another bullet point, I think, for the bulls. Yeah, pretty dramatic chart. It's really interesting to see the gains coming out of those periods. Fascinating. Great visual. All right, let's get into our last chart here, and then we'll take it over to Q&A. So again, we're looking at 1, 3, 6, and 12-month returns, but this time it's following a 20% gain off the lows of a prior bear market.
and really looking at whether or not that was the true bottom, right, Ryan? So what did you pull out of this?
Yeah. So again, we heard about this all over TV last week. Up 20%. People are finally realizing stocks have been up a lot since the October lows. Well, finally up 20%. That's the definition, not my definition, the media's definition, a new bull market, a new bull market. We've been on record since November saying the lows we're in a new bull market. But hey, that's what the media runs with. So what does it mean, right? When you're up 20% like we just were, I guess do I have the day? Well, no, I guess I don't quite have the day in there, but it just happened recently. A year after you're up 20%, you can see it there. A year later, higher 12 out of 13 times, up 17.7% on average after a 20% bounce. So again, could you go back and make new lows? Yes. I've got so see the word no there. A couple times in 2000. Then we saw big bounces during the tech bubble bear market. We saw a big bounce, very big volatility, late 2007, 2008. So we saw some of those bounces. Those broke to new lows. Yes. But those, I don't think, were very normal bear markets. We just had, in my opinion, a very normal bear market last year. Normal bear markets, once you're up 20, you don't go back and break the lows again. In fact, a year later, up 17%, again, higher, 17.7% on average, higher, 12 out of 13. I'm going to rewind for a second. So layer on that, and then last comment on this, we just made 52-week highs on the S&P 500 after going a year. I already said this, but I want to point it out with this chart here. When you lay these two together, very powerful, in my opinion. 52-week highs on the S&P 500 just last week for the first time since early 2021. So a long time without a 52-week high. 1 year later, that's higher. The S&P is higher, 15 out of 15, up about 17% on average. This is about 17% on average, higher 12 out of 13. You layer these things on top of each other, and it tells me, hey, stocks can pull back. In fact, maybe I hope they pull back a little bit, give us a better chance to get in. We're staying overweight. These are these studies and cycles that we see time and time again that do suggest, again, stocks, if we get to do this next summer, middle, right around Flag Day, like we are right now, I think there's a good chance stocks are going to be a good deal higher, and a lot of these studies to confirm that.
Yeah, just awesome data in here. Great job pulling this stuff out. It's really compelling. So we're gonna take over the Q&A session now. Keep in mind, down at the bottom of your screen, you can open up Q&A. You can drop your questions in there. It looks like we've already got a few. So Ryan, we can kick things off here. The first one I saw come in was, Ryan, could you provide an example of a shiny object stock or fund?
Yeah. Well, I wouldn't necessarily talk about fund, maybe ETFs or sectors. I mean, to me right now, the shiny object is tech, right? Tech communications. They've done a Tesla, again, not a recommendation, but these things have done really well. All of a sudden, people are starting to get really excited about. And I think that when I say shiny object, that's what I mean. Again, like working with advisors, like I get to, I can tell you, I hear time and time again, well, now my client wants to get in this, and it's whatever the hot thing is, right? Rarely do they want to get in the worst thing, and maybe you don't always want to get into the worst thing, but rebalancing and using some of those factors. If you've got some real good gains, your rebalancing doesn't makes a lot of sense to me. So that's what I say when I'm saying shiny object. So the one right now, again, is not gold, even though gold is shiny. I think it'd be more the tech communications, which have done absolutely incredible, but again, probably a little near-term stretched. And maybe if you have a 10 or 15% correction in some of those names that are so very much, that'd be a good time to get in. But just to blindly go all in tech right here or sell, what's underperforming. Small caps haven't done that well, right? Let's say you sell your small caps right now and you go all into some big tech ETF or something like that, maybe NASDAQ 100, something like that. That might not be the best time to do that, because that rubber band is stretched a long way, and all of a sudden, we're starting to see some strength out of small caps. And again, as the things broaden out, that's where I think you want to go.
Makes sense. We got a few more great questions coming in. So one here is, you said earlier we're getting closer to normal. Mm-hmm. Is that because we're close to having old normal rates, yields that are going close, CPI? How do you kind of define normal?
Oh boy, what is normal? This is a bigger question.
Normal?
Yeah, no, I think our answer to that, when I look at, let's go back to kind of what we wrote about in our outlook, is getting CPI back to normal, right? Getting the Fed, instead of hiking from 0 to 500 basis points like they did in 10, 11 months or 10 straight hikes. Stop doing that. They had to do it. We get it. But more normal now is that. And I want to be clear on this. So CPI ran about 2%, give or take, for like last decade. We do think after COVID, after everything that's happened, we might be running more like 3.5% CPI. I mean, CPI yesterday came in at 4% or 2 days ago, whenever it was. It's all a blur. But we think, it's going to come down a little bit more. Rents and things are coming down. The services part has been sticky. We get all of those things, but we think that's more normal. I'll tell you one other thing. Look at United Health yesterday, right? Again, not a recommendation, but stock was hammered. Why did they say they were hammered? Because more people are doing surgeries. You think about it, That's getting back to normal. People might have put off surgery because why? Because of COVID, because of they're concerned about their job, because of worries that are out there. And now they're willing to go get that surgery that they probably should have got a year or two ago, but they kept putting off that. Now, believe me, it wasn't very good for the health stocks and United Healthcare, but that's getting back to normal because people are doing what they should be doing.
Few more in here that are interesting. So what might make you turn bearish, right? Any signal, any action in the market, an economic data point? What do you watch out for?
Yeah, I mean, a couple. I like to use simplist. I say I'm a cocktail napkin technician. Okay, let's say we go beneath the 200-day. We're well above the 200-day. 200-day is curling higher, like as we speak here. So those would be some of the worrisome signs if we start to see some weakness from those long-term technical trends. If you and we don't have it, I know, but like the 200-week moving average on the S&P 500 that nailed the lows last October, 50% correction of the bear market as well. So there's some longer-term trends that if we were to violate those, that would get me. But the number one, as I talk about this, the number one thing. I don't know, bearish is the right way, but get me a lot more cautious near term. Will be more strength out of utilities, out of staples, out of certain parts of healthcare. If we see more relative strength from those more defensive areas, which we saw, let's not forget, we were seeing that, pre-COVID. I mean, like the market didn't know COVID was coming, I don't think, but we saw that leadership the fourth quarter, I guess it would have been of 2019. Yeah, 2019, we saw defensive leadership into early 2020, and then everything fell apart. We understand that. So if I see more leadership there, which we're not, fortunately, we're not seeing that yet, that would cause me to get a little more cautious. And the other thing is the consumer. We keep seeing positive data on the consumer. I keep hearing all this negative stuff about the consumer. We look at it on our team, at the Carson Investment Research team, the consumer is still pretty darn strong. If we start seeing some negative job prints, we start seeing some real concerns out of the consumer, which we're not yet, that would get me a little more worried as well.
The next one here is, how do you feel about international and how do you feel about small cap?
Yeah. Well, I'll start with small cap. We're overweight small cap. We came into this year overweight small cap. Small cap is having a great year. And then the regional bank crisis, a lot of those banks literally went to like zero, which hurt small caps. But again, where we are right now, right, looking at things out the next 6 to 12 months or so, we really do think that the opportunity is small caps could do really well, play catch up, right? Kind of some of the themes we've talked about already, but catching up to the large cap. Now, that just because we're overweight large relative to small, that doesn't mean we have more small in the models we run for our advisors. We have more large cap exposure, but just as a percentage basis and all the different models and the way we slice and dice things, we do have a tad more small cap exposure than probably your average fund and your average model would. And again, it's because we think there's no likely recession coming. And if you think about also small caps, they trade a lot like financials. Financials are starting to bottom. Regional banks have started to look good. I mean, believe me, people look at financials and they get really scared, but there are some positive. The XLF, the large financial ETF, I think 30 was the peak back in 2007. We flirted there, previous resistance, now support. One of the reasons we added some financial exposure back in March, actually, with all that negativity that was there. So we do like small caps here, or overweight small caps for at least the second half of this year or so. Believe me, we can change our opinion tomorrow, but for now, we do think there's a lot of opportunity small caps. In international investments, I mean, it's nice to see other parts of the world. EM's struggled, but a lot of other parts of the world have done really well. I mean, Japan, we've talked about Japan highest level since, I don't know what, 1990, 1991, something like that. The DAX was up 20% not too long ago, making new highs. France also, CAC 40. So there's nice participation. Now, we still are overweight the U.S. We like the U.S. the most. We put developed international in the middle there. In emerging markets, it is what it is. We've seen some concerns there. China, we're not so sure about what's going on with Chinese data and some of the valuations. So we have positioned ourselves that way. Now, we did just upgrade developed international maybe 2.5, 3 months ago from underweight to even weight. So we got a little more. We're seeing some more positive things. I mean, you talk about it. I got to make this fast. I know we're getting close to the end. You think about like manufacturing. Manufacturing in Europe is like really improved. It's well off the lows. There's some strength coming. This time a year ago, everybody said, including me, honestly, if you talked to me a year ago, yeah, Europe being in a recession right now. Fortunately, we just had one of the warmest winters we ever had. Mother Nature kind of saved the day as it pertained to the terrible war and different things that are going on in Europe. And they didn't go into recession. And Europe is starting to thrive. And the strong strength we've seen out of a lot of European markets and Japan, so let's call it developed international, those are positive things. And Japan, again, they've had low inflation for a while, seen a little more inflation. That's not a bad thing, and more growth. So that's we're more even weight again, developed international. So it's the first time in a while I think you can start looking at developed international and finding some potential opportunity. But at the same time, small and developed international, they kind of do trade. It's not perfect, believe me, but they do trade somewhat alike. And maybe there's opportunity for both of those here in the next 6 to 12 months.
Why don't we try to squeeze one more in here and then I can wrap things up for us. This last one was, should we be interested in value, blend, or growth going forward? It seems like value has the best valuations, but might underperform. And I think you've touched on this a little before, but interesting question.
Yeah, I mean, it depends on the investor. I mean, how tactical you are and where you are. I mean, a little bit of blend makes sense, but where we are slightly tilting our portfolio, cyclical value. If you say value, well, I mean, I think utilities part of that, staples are part of that. We're underweight those. We like industrials is our favorite sector out of the 11. We've overweighted to small caps. Materials we're more neutral, but there's potential positives in materials as well. So the cyclical value area is where we are overweight here. But again, just using rebalancing and continuing to follow your plan and working, either with yourself or working with a smart advisor to kind of sometimes help you from yourself is the biggest thing when it comes to a lot of these things. But that's where we are absolutely tilted to, is cyclical value and small caps, in the more tactical models that we run for our advisors.
Makes sense. And right on time. We'll want to wrap up here. Thanks everybody so much for joining today. Thanks Ryan for putting out such great content and for joining us and sharing your perspectives on the market. It was really fun. Learned a lot. For anyone interested in learning a little bit more about YCharts and how you can create some of these visuals or get at some of this data, there's a QR code in the upper right-hand corner there. You can go to YCharts.com, sign up for a free trial, hit sales@YCharts.com with an email, and we're happy to help. For anyone interested in following Ryan, where can they find you?
Yeah, at Ryan Detrick, RyanDetrick on Twitter, on LinkedIn too. But Twitter is kind of where it's at, right? I got to do a lot on Twitter there. And then carsongroup.com is our blog. And then also Facts versus Feelings. I have a weekly podcast. It's fairly new. It's been real popular. So Facts versus Feelings is my podcast. You can follow that as well. If you liked anything I just said, we do that every week on there. So fastest hour of my week. This was fun. I really appreciate the opportunity, and thank you for so many people staying the whole time. You never know. You look down like, oh, did people stay? Yeah, everybody stayed. So hopefully it means you liked it.
Love that. We loved having you, Ryan. Thanks so much. Thanks again, everybody, for joining. Hope to see you all soon.
All right. Take care. Thank
everybody.
You. Bye.
Bye.